We are going to be discussing MedMal 101, specifically tail coverage today. This is being presented by L&J Insurance Services, which is a boutique medical malpractice insurance brokerage that focuses on individual healthcare providers and small groups. And my name is Hannah. So what are we going to be looking at today? First is, what is tail? We find that a lot of healthcare providers will know that tail is important. It's something they should be asking about. They don't understand necessarily what it is or why it matters. So we'll be covering that. We'll also be taking a look at the common costs and timelines associated with tail coverage. We'll take a look at DD&R, called Death, Disability, and Retirement, which is an amazing benefit offered by some medical malpractice insurance companies. We'll also be looking at tail strategies, so how to mitigate the costs associated with tail or how to avoid having to purchase tail altogether. We'll also take a look at some common coverage structures for med-mal insurance that will influence whether or not tail needs to be purchased. And then we'll talk about the benefits of using a broker when navigating this really complex financial decision. So first, what is tail? So tail is known by its formal name in the med-mal world as Extended Reporting Period, or ERP. And what this does is it gives a provider extra time to report a claim that comes up after the policy has been canceled, but for incidents that occurred while the policy was in place. So let's put some numbers behind this to kind of create some context. So for example, let's say you were insured with insurance company ABC from January 1st, 2024 to January 1st, 2025. You canceled your policy in 2025. 3 months after canceling, you receive a claim for an incident that happened on 5/1/2024. So almost right in the middle of that 1 year period that you were insured with ABC Insurance Company. If you do not purchase tail, you cannot report that claim that came 3 months after the cancellation of the policy. So you are now on the hook for that personally and financially. If you do purchase tail upon canceling the policy, you then are able to go back and report that claim that arose 3 months after the cancellation of the policy. So really what this does is it closes that coverage gap. It allows you an extended reporting period or an extended period of time to report claims after they've been canceled. Now, one important thing to keep in mind, and we'll get into a lot more of the nuances of this later, but tail is only necessary when a policy is canceled. If your coverage is active, if it's currently present, you don't need tail coverage at this point in time. So why is this significant? So not only do we just talk about this incredible gap that you can be creating by not purchasing tail, which means that you're going to then be on the hook for any kind of claims that arise, this really is going to impact your future insurability with either the same med-mal insurance carrier or others. When you fill out an application for medical malpractice insurance, you have to disclose whether or not you have any gaps in coverage. Obviously, gaps in coverage are going to be viewed as unfavorable to the current or new insurance company that you're applying with. What this says is when a healthcare provider does not purchase tail, it says to the insurance company that they are an undue risk taker. We hear from healthcare providers all the time who say, hey, my patient population is so low risk. They love me. I'm not worried about any claims arising. But the issue here is that you've been presented with an opportunity to shore up your gaps to make sure that you don't have any gaps in coverage and you've opted out of that. And so that says to future med-mal insurance companies, proceed with caution. This person is a bit of a risk taker. So what that could result is automatic declinations for coverage when you apply in future instances, or debits in which an insurance company will add an extra debit, usually around 10%, to your insurance premium for a number of years. So you're now paying this penalty because you didn't acquire tail coverage when you had the opportunity. So what are some costs and typical timelines associated with tail? So when do you purchase tail? You purchase tail upon canceling a policy or a specific set of limits, which we'll talk about towards the end here. But really, when you're making a big coverage change and coverage is going to be terminated, that's when you have the decision whether or not to purchase tail. There also may be some strategic benefits to purchasing tail early. So, for example, if you want to help seal off a really undesirable exposure. So, we see this in reference to OBGYNs, for instance. They have numerous years of OB experience and then have decided later in their career they want to step down to GYN only. Well, you can't just automatically step down from the OBGYN rate to the GYN only rate. You usually have to be tapered down over a certain number of years in terms of your premium. So, one advantage may be siphoning off that OB risk, purchasing tail, sealing it off, and then moving forward, GIN only in order to save money. That's really where your broker comes in. They can help explain all of the different potential benefits there that are going to be impactful and that should be considered when thinking about purchasing tail. Now, in terms of pricing, tail coverage is usually about 2 to 3 times the expiring premium. So take a look at your declarations page. It's one of the first few pages of your insurance policy, and on that it's going to list your annual premium. Take a look at that annual number, multiply it by 2 to 3, and it's going to give you a really good ballpark indication for what you can expect your tail coverage to be. Each insurance company is going to have a specific equation by which they multiply the expiring premium, but it's usually within that 2 to 3 range. Now, keep in mind that tail coverage usually has to be paid in full upfront within 30 days of the policy's expiration. So, for a really high risk physician, for instance, high specialty risk, this could be up to 6 figures. So, you have to make sure that you have those funds readily available, ready to go within 30 days of the policy being canceled. Typically, the tail coverage cannot be canceled. Payment is due upfront in full, and no financing is usually available. Now, duration, it really depends on the insurance company and your policy form. Some insurance companies will offer infinite or lifetime tail, so you can report a claim that arose 20 years after the incident if it so happens to pass that statute of limitations. Or some insurance companies will offer durations with increasing time equating to higher costs. So that could be 1, 3, 5 year tails. Some states have very specific requirements about the duration that an insurance company has to offer, but you have to look at your policy language, and that's where your broker can help interpret that for you. So now taking a look at DD&R, called Death, Disability, and Retirement. And this is a benefit that's offered by some insurance companies as a free benefit and really incentivizes you to stay with them as an insured. What this means is upon your death, your disability, or your permanent retirement from the practice of medicine, you will receive free tail. Now, retirement is not moving to part-time, doing locums work, serving as a medical director. Retirement truly means from the insurance company that you do not take payment as a form of a healthcare provider ever again. So one thing that's really important to keep in mind is because we've talked about how expensive tail coverage can be, it may be worth prioritizing paying a higher premium for a policy that includes death, disability, and retirement rather than opting for a lower premium policy that does not include this amazing benefit. So again, that's where you can discuss with your broker, really identifying what terms are available when you're comparing different insurance policies and looking at premium and doing some back of the envelope math to see whether or not it's more impactful to actually pay a higher premium now in order to have this benefit down the line. Now, each carrier who offers the DD&R is going to have their own specific set of requirements in order for you to qualify for that free tail, particularly in the retirement setting. But here's kind of an overview of what you can expect to see. So most insurance carriers are going to require that your account be in good standing, so meaning you haven't been canceled due to non-pay, for example. A lot will require a mature retroactive date. So again, take a look at that declarations page. Take a look at the retroactive date or prior acts date that's listed on that certificate of insurance or declarations page. A mature retro date means that there are at least 5 years of exposure associated with that. So long as your retroactive date is mature, and if this is a requirement, then you'd be eligible for tail. The policyholder typically has to be insured continuously with the same insurance company for a number of years. That usually ranges from about 1 to 5. And then oftentimes we see with retirement specifically that a provider has to reach a certain age. Usually this is 55 plus, but that varies by carrier. And then for retirement specifically, retirement cannot be related to the suspension, surrender, revocation, or non-renewal of your medical license as requested by an authority. So if, for instance, the medical board says, we have all of this action and activity on you, and you decide, okay, I'm going to actually just surrender my license, well, that's been due to a medical board action, and so you now no longer qualify for that free tail because you're not retiring by choice. You're retiring because you're no longer a licensed healthcare provider. So what are some strategies to help mitigate the cost of tail or having to purchase tail in its entirety? Tail can be brought on by a lot of different instances in a physician or healthcare provider's career, such as changing jobs, retiring, moving to a new state. So there really has to be a lot of consideration here. One of those is tail versus nose. So there's really kind of two ways to skin the cat here when you have a retroactive date. Again, look at your declarations page, look at that retroactive date, also called prior act date, and you'll see what I'm talking about. So what we can do is you can either purchase tail coverage, which again is that kind of one lump sum, expensive, cannot be canceled. Um, fee upfront that you will then use to seal off any exposure when you cancel a policy. The alternative is you can request nose coverage from a different carrier. So what that means is, say you've been insured with ABC Insurance Company for 5 years. You then apply for coverage with ABC XYZ Insurance Company. So you've been with one for 5 years, you're moving to XYZ. You apply for those 5 years that you were with ABC and now onto your sixth year. So what you're going to do is you're going to basically move everything that you had at ABC Insurance Company over to XYZ, and it'll be like ABC Insurance Company never even existed. Any claims that come up, you're going to be reporting just to X, Y, and Z because you brought your prior acts, all of those previous patient exposures with you to that new medical malpractice insurance company. And this is called NOS. So it's keeping your prior act state intact. You do not have to cancel and purchase tail because in this instance, coverage is still going on. It's still continuous. Another option is to look for standalone tail coverage. So with that, you would use a broker. We have access to multiple markets that do offer standalone tail, so meaning it's a completely separate policy that really just offers tail coverage for a provider. Now, these are a bit tricky. Typically, the terms that are offered under a standalone tail policy are a little bit less desirable than those that are offered by your previous insurance company. So really, you have to take a look at that, really have your broker explain the differences and see whether or not the financial trade-off is worth it. It can also be incredibly difficult to acquire standalone tail coverage for certain specialties, high-risk specialties, it's almost impossible. And if you've ever had previous claims experience with the previous company, it can be very challenging to find standalone tail. Another thing that we suggest that providers do when they're looking at new employment, for example, is negotiating up front. So what you can do is ask for a signing bonus. And this can help pay for policies that you're currently canceling. So for example, if you're canceling your solo policy and moving to the group policy, ask for that signing bonus to help cover that cost. Another thing you can do is try to negotiate for your employer to pay all or a portion of your tail upon leaving. We often see in contracts, a physician who stays for 5 years, for example, under this certain employment contract will then be eligible for free tail on behalf of the employer. Something else you can do is keep your solo policy intact and ask your new employer to pay the premium or cut you a check equivalent to the premium for your individual med-mal policy. Again, because the policy is in place, it hasn't been canceled, you don't need to purchase tail in that instance, and so it's going to be a big savings to you. Now, taking a look at some coverage structures that are going to be influencing whether or not tail needs to be purchased. There are two kind of main medical malpractice insurance policy structures, and that's claims made versus occurrence. There's going to be a lot of nuance there in terms of how a claim can be reported, timeframes, a lot of things of that nature. But at a very, very high level, occurrence essentially has tail coverage built in. So you do not have to purchase tail upon canceling an occurrence-based policy. Now, occurrence-based policies are much more expensive. They're typically about 2 to 3 times the cost of a claims-made policy. And they can be incredibly difficult to procure. They're very common for ancillary providers, but they're very challenging for healthcare, for physicians to get, especially in certain states. Physicians in California, for instance, it's almost impossible to acquire an occurrence-based policy, and nearly everyone is written on a claims-made basis. On a claims-made basis, if you cancel your policy, tail has to be purchased. The reason why it's so challenging to find claims-made policies or occurrence policies, excuse me, is because occurrence policies can be very challenging for an insurance company to price out. They're pricing out for the current market structure, but they're also thinking ahead to if we're offering lifetime tail as a part of this policy, what are those future claims going to look like? How can the market be changed and be influenced over time? It's just very challenging. So that's why oftentimes claims made is the only kind of real option for a provider. Now, looking at kind of deeper into the policy structure itself, we're going to take a look at limits and how those affect purchasing tail. So there's kind of two ways that limits can be structured, shared versus separate. So let's take a physician in California, for example. Their standard set of limits is 1 million, 3 million per usually hospital requirement. So what that means is if a physician has a separate set of limits, it means they have their own 1 million, 3 million bucket that's been assigned to them. And that's where money can be pulled from to pay for claims for which they're specifically named. Now, if they have shared limits, so for example, you have a nurse practitioner sharing limits with an MD, the nurse practitioner and MD are sharing that same set of 1 million, 3 million limits. They're pulling from the same bucket. So if they're both named within the same claim, they're pulling from that same set of 1 million, 3 million limits. The way that this influences tail is if you have separate limits and you leave, as the physician, you leave the policy, for example, you have to purchase tail because your set of limits that was specifically assigned to you need to be closed off and need to be shut down. And that would be in the form of tail insurance. If you have shared limits, so for instance, the nurse practitioner decides to leave and she's sharing limits with a physician, the nurse practitioner does not need to purchase tail because the physician is continuing on with their coverage. That 1 million, 3 million bucket that they shared is still continuing on. It hasn't been canceled in its entirety, and so tail coverage is not needed in that instance. So why is L&J the broker that you need for this? As we discussed, tail coverage can be incredibly expensive, very nuanced. You're under a very tight time frame in order to make really important decisions for yourself and for your coverage, also for your wallet. And so that's why we're here. We are an independent boutique brokerage, third generation. We are healthcare provider founded. So my grandmother, nurse risk manager, was the one who started L&J Insurance Services, really with the goal of taking care of the caretaker. We pride ourselves on being readily accessible. We don't have an 800 number. We don't have an extensive phone tree. Everything goes directly to our cell phones, and we work when healthcare providers work, so that's all the time. In terms of advocacy, we are here to represent you. We do not represent the insurance company. Our job is to collect your information, share your story with the marketplace, provide a comprehensive market summary so you understand exactly where you fall within the market search, and we go over all of the terms, all of the pricing so you make a really educated decision for yourself. And we also serve as the role of consultant. We know the right questions to ask so you don't have to guess. We're here to help you make informed business decisions that are best for you and your future. So what are some next steps? We can help you with seeking new coverage. It's either finding a brand new policy or replacing an existing policy that you have with better pricing and terms. We can also simply take over the servicing of your current policy. So we can do something called a broker of record letter, which means that we become your then primary point of contact. We interface with the insurance company for you, so you don't have to call that generic customer service line. We become your point person. We do everything to make sure that you are well taken care of. We can also help you find complementary coverages. We specialize in medical malpractice insurance, but do offer a handful of other coverages that are really complementary to physician and healthcare provider practices. That could be cyber insurance, for example, making sure that your entity is covered, making sure that you have vicarious liability, which would mean that you have coverage for any healthcare providers who carry their own med mal insurance, and so on. We're also happy to do a coverage review. We can take a look at all the coverages that you have and see if we can find any gaps or existing red flags. And of course, we're here to answer questions. We can provide high-level feedback, explain market trends, explain your positioning within the marketplace, and everything in between. So thank you so much for attending. In order to keep in touch, feel free to reach out on our website, www.custommedmal.com. You're also welcome to send us an email at hello@custommedmal.com. We're here to answer all of your questions. We also have a monthly newsletter, MedMal 101, and you're welcome to follow us on social media to stay attuned of all of the changes that are happening in the medical malpractice insurance marketplace. Thank you so much.